For more on this week's wild ride here, we want to welcome in our first guest. We've got Mark Luschini, the Chief Investment Strategist at Janney Montgomery Scott. It's great to have you on. So listen, when I look at what's going on in the markets here with Josh, it's looking like, did this all matter? Was this much ado about nothing over the past 7 days here?
Well, imagine as we sit here on a Friday afternoon after 3 o'clock, and had you not known what had transpired over the course of the week, you would think that basically nothing had happened. We're down a couple of tenths of 1% on a week-over-week basis at this juncture. We know it was Dramamine-inducing activity over the course of the week on a couple of things that I think are certainly worth monitoring as we go forward. I don't think we're necessarily wanting to be overly complacent with regard to certainly the jobs report we got on Friday, although Thursday's weekly claims number gave some assurance that perhaps companies aren't shedding workers quite to the same degree as the weakness that was attributed to the jobs report suggests that they might be. In addition to that, the unwinding the carry trade seems to be in its later innings, and an official from the Bank of Japan came out and seemed to have calmed fears with regard to any further activity on the part of the Bank of Japan that would jar markets any further. And so, collectively, I think we're ending kind of where we're beginning, which is to say the economy continues to look like it's in pretty good shape. The Atlanta Fed GDP Now tracker is coming in at 2.9% for activity here so far into the third quarter, which is a continuation of a reasonably good economic climate that should be fertile for stocks. So it's no surprise that we've seen, a rather impetuous, perhaps, rebound in equity prices by way of yesterday's activity, but something at least allowing investors to take their breath.
It was interesting, Mark, because, earlier in the week when there was that, Monday, there real sense of panic there, red everywhere. You heard a lot of criticism of the Fed, Mark. I mean, people were really out there, even pounding the table. All right, maybe we need an emergency cut. Jay Powell has screwed this up. The Fed is behind the curve. They should have lowered faster. It doesn't sound, Mark, like you're in that camp, though.
No, not at all. In fact, I think they could have actually exaggerated the crisis of the moment had they acted or came out and made some statement, even if it was an effort to calm the markets, because I think the markets might have interpreted it that it was something that had gotten their attention, certainly, and warranted some comment to suggest that perhaps something even more nefarious was taking place behind the scenes that wasn't obvious to market observers. So, no, I'm assured by the fact that the Federal Reserve, one, didn't act by adjusting rate policy, or two, have to come out and make some commentary relative to the activity and really allow for the markets to settle down once I think cooler heads prevailed with regard to the activity that, at least so far, hasn't manifested into something that looks particularly sinister. And in fact, is probably what to be expected. One, we're in a seasonally weak period for stocks, August and September, and we haven't seen the kind of volatility nor a drawdown that was around 10% on a year-to-date basis, which is highly unusual. So this is more normal and customary. Sentiment got a little bit too extreme to the enthusiastic side, and that had to be reset. And we've gone through a pretty quick reset of that, but nonetheless, I think it's a setup for calmer markets to prevail.
Is this sentiment reset a buying opportunity? And if so, where's that opportunity?
Well, I think it is, largely speaking. I do expect further volatility over the next couple of months. The presidential cycle analogs suggest that we continue to see some weakness here leading up to the election. In addition to that, there is still, I think, some concern that is worthwhile noting that the economy is beginning to moderate. The job market is cooling, so we'll have to continue to watch the data that suggests that the labor market remains relatively healthy. So at the end of the day, though, while we're not abandoning those sectors that have been leaders on a year-to-date basis, namely some of those great iconic brands in technology, communication services, and consumer discretionary, we are suggesting to investors that perhaps they continue to bolster their portfolio by adding positions or taking an overweight in sectors like real estate and in healthcare and utilities, more classic defensive sectors, as a means of balancing out the risk in the event we do see further moderation of growth that does suggest that some of the risks that suddenly have risen around the prospects of a recession ultimately become validated.
Mark, I got to ask you about the election. Got to talk about politics for just 1 second, Mark. The election impact on the markets. When clients ask you, Mark, what do you tell them?
Well, at the end of the day, for long-term investors, they really don't have a substantial influence on the markets. I mean, certainly we've seen a lot of positioning and posturing with regard to sectors that might outperform or underperform relative to who the candidate might be. Obviously, so much not only depends on who's occupying the White House, but the composition of Congress and as well the economic backdrop that persists at the moment that a changeover in the administration takes place. So I want to try to front run that activity, focus on the long term, and allow your asset allocation to help to weather, by way of risk management, the inevitable moments in time where investors will become, flustered over some comment being made by a candidate or some policy initiatives that, at face value, might look potentially disrupting for the markets, and focus on the long term, where over time we know investors have been rewarded for staying the course through any potentially climatic or intermediate term influence on markets that have a political orientation in their nature.
All right, Mark, we're going to have to leave it there. Thanks for joining us. Really appreciate it.
Sure. Thank you.